Financial forecasting. Financial forecasting is the process of estimating or predicting how a business will perform in the future. This can include predicting future revenue, expenses, and capital needs. It is a crucial part of a company's strategic planning process as it helps them to make informed decisions about how to allocate resources and pursue growth opportunities. Think of financial forecasting like guessing what you'll score on your final exams based on your current study habits. Businesses do the same, but with money. They use what they know about their current financial situation to predict what might happen in the future. This helps them prepare and make better decisions. Percentage of sales forecasting. Percentage of sales forecasting is a popular financial forecasting method that makes use of historical sales data to predict future financial outcomes. Essentially, it's based on the assumption that most items on the income statement and the balance sheet will change proportionally with sales. This method is like predicting how much taller you'll grow next year based on your growth this year. Let's say you grew 2 inches last year. If you predict you'll grow the same amount next year, you'll end up 2 inches taller. Example of percentage of sales forecasting. If sales were expected to increase by 10%, a firm using the percentage of sales method would typically forecast that its expenses and certain balance sheet items, like accounts receivable and inventory, would also increase by 10%. For instance, if a company's sales go up, they'll likely need to spend more money on making the products they sell. They use the percentage of sales method to guess how much more they'll need to spend. Importance of percentage of sales forecasting. This method is especially useful for firms with stable operations where costs and revenues grow at a consistent and predictable rate. It simplifies the forecasting process by allowing managers to apply a single growth rate to multiple accounts rather than making separate forecasts for each one. Use in pro forma financials. Pro forma financial statements are projected financial statements. They show how actual financial statements might have looked if certain assumptions, like a projected growth rate, had been realized. By using the percentage of sales method, a company can create pro forma financial statements to forecast its income statement and balance sheet. This is just a fancy term for a business's financial report that shows what they expect their money situation to look like in the future. It's like a what-if scenario. For example, what if our sales go up by 10%? What will our expenses look like then? Estimating additional funding needs. Another vital use of the percentage of sales method is in estimating a company's additional funding needs. If a firm plans to grow its sales, it will likely need additional resources to support this growth, such as more inventory or larger receivables. By forecasting these changes, the firm can estimate its additional financing needs and plan accordingly. Additional funding. This is the extra money a business might need if they want to increase their sales. It's like needing more pocket money if you plan to buy more snacks at school. By forecasting, the business can figure out how much extra money they might need and where to get it from. Spontaneous account. These are accounts that change naturally with sales. Think of it as the amount of food you'd have to buy if you had more friends over. The more friends you invite sales, the more food you need. Spontaneous account. For a business, these could be things like the cost of materials to make their products. In conclusion, all these terms and techniques help a business understand their money situation better. Just like how you plan your studies for exams or budget your pocket money, businesses need to plan and budget their finances for future growth and success. The percentage of sales method is an efficient and practical tool for financial forecasting. It can help firms to project their financial statements, anticipate their funding needs, and make strategic decisions. Financial forecasting. This is like trying to predict the future of a business. It's a bit like weather forecasting, but for finances. You look at things like how much money a business is making, how much it's spending, and then try to guess what will happen in the future. It's important because, much like you wouldn't leave the house without checking the weather, businesses wouldn't want to make big decisions without first trying to predict financial outcomes. Percentage of sales forecasting. Imagine you have a lemonade stand, and last year you sold 100 cups of lemonade and spent $50 on lemons. If you want to sell 200 cups this year, you would expect to spend about $100 on lemons. That's the basic idea behind percentage of sales forecasting. If your sales grow, your costs and other things like inventory or money owed to you will likely grow at the same rate. It's a quick and easy way to guess what might happen in the future. Spontaneous accounts. These are accounts that change automatically when your sales change. Like in the lemonade stand example, the amount of money you spend on lemons would be a spontaneous account because it increases automatically when your sales increase. In conclusion, all these terms and techniques help a business understand their money situation better. Just like how you plan your studies for exams or budget your pocket money, businesses need to plan and budget their finances for future growth and success. The percentage of sales method is an efficient and practical tool for financial forecasting. It can help firms to project their financial statements, anticipate their funding needs, and make strategic decisions. Sustainable growth rate using DuPont equation. The DuPont equation is like a financial health checkup. It's a formula that helps you understand how well a business is doing by looking at how much profit it's making, how efficiently it's using its assets, and how much financial risk it's taking on. The sustainable growth rate is the fastest rate a business can grow without borrowing more money. It's like asking, how big can my lemonade stand get before I need a loan for more lemons? Additional funds needed AFN. Imagine you want to sell 300 cups of lemonade next year, but you only have enough money to buy lemons for 200 cups. The money you need to buy lemons for those extra 100 cups is the additional funds needed. It helps businesses plan for growth and know when they might need to borrow money or find new investors. Discretionary funds needed DFN. This is money that a business needs but has some control over when and how they spend it. Suppose your lemonade stand is doing really well, and you decide you want to buy a fancy new sign to attract more customers. The money for that sign would be a discretionary fund. It's a cost that could potentially help your business grow, but it's not essential, and you can decide when to spend it. Sales growth rate formula. Sales growth rate equals forecasted sales slash last year's sales 1 forecasted sales. Explanation: forecasted sales. This refers to the estimated or projected sales for the upcoming period. It's an educated guess based on various factors like market trends, economic conditions, historical sales data, and any other relevant information. Last year's sales. This is the total sales revenue generated in the previous year. It serves as a reference point to compare the current year's projected sales and see how much growth or decline is expected. Sales growth rate. This is the percentage by which the sales are expected to increase or decrease in the coming year. It is a crucial metric for financial forecasting as it helps businesses plan their operations, set targets, and allocate resources effectively. Importance of sales growth rate. Financial forecasting. Forecasting sales growth is a fundamental step in financial forecasting. By predicting how much sales will increase or decrease, businesses can create accurate projections for their income statement and balance sheet. This, in turn, enables them to plan their expenses, investments, and profits. Resource allocation. Knowing the expected sales growth rate helps companies determine how much inventory to produce or purchase, how many employees to hire, and how much production capacity to utilize. It ensures that resources are allocated optimally to meet future demand. Investment decisions. Investment decisions. For investors and stakeholders, the sales growth rate is a critical indicator of a company's performance and potential. Higher sales growth rates generally suggest a healthy and expanding business, making it an attractive option for potential investors. Identifying trends. Analyzing sales growth rates over multiple periods can reveal trends in consumer behavior, market conditions, and the effectiveness of business strategies. It allows businesses to adjust their approaches accordingly. Financial health. Steady and positive sales growth is vital for a company's financial health and long-term sustainability. Consistent growth ensures a stable revenue stream, making it easier for businesses to manage their operations and debt obligations. Competitive analysis. Comparing the company's sales growth rate with that of its competitors can provide insights into its market position and potential for gaining or losing market share. Summary. In summary, the sales growth rate is a crucial metric that helps businesses and investors understand the expected changes in sales revenue. It drives financial forecasting, resource planning, and investment decisions, all providing valuable insights into a company's performance and position in the market. Sales growth rate formula. Sales growth rate equals forecasted sales slash last year's sales 1. Example: 2017 sales were $50 million, and we are forecasting 2018 sales to be $60 million. What is the sales growth rate? Forecasted sales equals $60 million. 2017 sales equals $50 million. Sales growth rate equals forecasted sales slash last year's sales 1. Sales growth rate equals 60 slash 50 to 1 equals 0.20 equals 20%. Explanation: forecasted sales. Forecasted sales. In this example, we are predicting that the sales for the year 2018 will be $60 million. This is the amount we anticipate the company will generate in sales for the upcoming year based on market analysis, business strategies, and other relevant factors. Explanation: Con. Last year's sales. This refers to the total sales revenue generated in the previous year, which is 2017 in this case. It serves as a benchmark for comparison, allowing us to see how much the sales are expected to grow or decline in the following year. Sales growth rate. This is the key metric we want to calculate. It tells us the percentage change in sales from the previous year to the forecasted year. In this example, the sales growth rate is 20%, which means the company is expected to experience a 20% increase in sales from 2017 to 2018. Why it's important. Financial planning. The sales growth rate is essential for financial planning and budgeting. It helps businesses estimate their future revenues and anticipate their financial performance for the upcoming year. Decisions. This information is crucial for setting realistic targets and making informed business decisions. Why it's important in business performance evaluation. Comparing the forecasted sales growth rate with the actual sales growth rate can provide insights into a company's performance. If the actual growth falls short of the forecast, it may indicate issues that need to be addressed, such as market challenges or operational inefficiencies. Why it's important in investment decisions. Investors, shareholders, and stakeholders often look at the sales growth rate to assess a company's potential for growth and profitability. A higher sales growth rate may attract more investors and positively impact the company's stock value. Why it's important in risk assessment. Understanding the sales growth rate helps businesses identify potential risks and challenges. Strategies accordingly. For instance, if the growth rate is declining, it may indicate market saturation, increased competition, or shifts in consumer preferences, prompting the company to adapt its resource allocation. Resource allocation. A reliable sales growth forecast allows businesses to allocate resources efficiently. For instance, if a company expects a significant increase in sales, it may need to invest in expanding production capacity, hiring more employees, or increasing inventory levels. Competitive analysis. Comparing the sales growth rate of one company with its competitors provides insights into market dynamics and a company's relative performance. 02. It helps identify areas where a business is excelling or lagging in comparison to its peers. Understanding sales growth rate. In summary, the sales growth rate is a crucial metric that helps businesses and investors understand the expected changes in sales revenue. It plays a vital role in financial planning, decision-making, and performance evaluation, enabling companies to stay competitive and thrive in the market. Let's calculate the sales growth rate for the given problem and then expand on the key notes in simple terms, explaining why they are important. Given information. Forecasted sales for next year equals $125 million. Current year sales equals $85 million. Sales growth rate formula. Sales growth rate equals forecasted sales / current year sales. Calculation. Sales growth rate equals 125 / 85 to 10 4706. Understanding the key metrics. Forecasted sales. In this problem, NSG, the company, is projecting or estimating that its sales for the next year will be $125 million. This forecast is based on various factors like market trends, historical data, growth strategies, and other relevant information. Current year sales. This is the sales revenue generated by NSG in the current year. It serves as the baseline for comparison and is essential to calculate the sales growth rate accurately. Sales growth rate. This is the key metric we want to find. It represents the percentage change in sales from the current year to the forecasted year. In this case, the sales growth rate is approximately 47.06%, indicating that NSG expects its sales to increase by around 47.06% in the next year. Significance of sales growth rate. Why it's important. Financial planning and budgeting. The sales growth rate is a critical component of financial forecasting. It helps companies plan their budgets and set financial targets for the upcoming year. A higher sales growth rate may require more resources, while a lower rate may lead to cost-cutting measures. Key terms. Business expansion and investment. A strong sales growth rate can attract investors and indicate that the company is on a growth trajectory. It provides confidence to investors that their investment may yield positive returns in the future. Performance evaluation. By comparing the projected sales growth rate with the actual growth rate, businesses can assess their performance. If the actual growth rate exceeds the forecast, it signals that the company is performing well and achieving its objectives. Operational decisions. Understanding the sales growth rate helps companies make operational decisions such as inventory management, production capacity planning, and hiring strategies. Anticipating higher sales growth may necessitate scaling up production and workforce. Competitive analysis. The sales growth rate also aids in benchmarking against competitors. It allows companies to gauge how well they are faring compared to others in the same industry or market. Risk management. A declining or lower than expected sales growth rate may indicate potential risks, such as market saturation or competitive challenges. Identifying these risks early enables businesses to develop mitigation strategies. Stakeholder communication. The sales growth rate is a key metric communicated to stakeholders, including shareholders, investors, and board members. It provides them with insights into the company's future prospects and helps build trust and confidence in the management's decisions. Summary of sales growth rate. In summary, the sales growth rate is a fundamental metric in financial forecasting that informs various aspects of a company's operations, strategic planning, and investor relations. It plays a crucial role in decision-making, performance evaluation, and assessing the company's overall health and potential for growth. Spontaneous accounts and their importance in financial forecasting. Let's expand on the key notes and explain in simple terms what spontaneous accounts are and why they are important in financial forecasting. Spontaneous accounts are accounts on the income statement and balance sheet that automatically change in value as sales change, and when sales increase, these accounts also increase, and when sales decrease, they decrease accordingly. Spontaneous accounts play a crucial role in financial forecasting as they help predict how various financial metrics will be impacted by changes in sales. Spontaneous accounts play a crucial role in financial forecasting as they help predict how various financial metrics will be impacted by changes in sales. Income statement accounts. Income statement accounts. Let's take a look at the spontaneous accounts on the income statement. Revenues. Revenues are the total sales generated by a company from its core business activities. As sales increase, revenues increase proportionally, and vice versa. Cost of goods sold (COGS). COGS represents the direct costs associated with producing the goods or services sold by the company. As sales increase, more goods or services are sold, leading to higher COGS. COGS increases with higher sales. Operating expenses. Operating expenses include various costs incurred to run the day-to-day operations of the business, such as salaries, rent, utilities, marketing, etc. These expenses often change with sales levels. For example, higher sales may require increased marketing expenses. Depreciation. Depreciation is a non-cash expense that represents the allocation of the cost of tangible assets over their useful lives. While not directly affected by sales, it's an essential part of the income statement. Taxes. Taxes represent the amount of income tax a company owes based on its profits. Taxes may vary based on changes in revenues and expenses. Balance sheet accounts. Balance sheet accounts. Now let's look at the spontaneous accounts on the balance sheet. Accounts receivables are amounts owed to the company by its customers for goods or services sold on credit. As sales increase, more customers owe money to the company, leading to higher accounts receivables. Accounts payables are amounts owed by the company to its suppliers for goods or services received on credit. As sales increase, the company may need to purchase more goods, leading to higher accounts payables. Accruals are expenses that have been incurred but not yet paid. For example, if the company hires more people to handle increased sales, the corresponding payroll expense will lead to higher accruals. Inventory represents the goods or raw materials a company holds for production or resale. When sales increase, more inventory may be required to meet the higher demand. Importance of spontaneous accounts in financial forecasting. Why they are important. Forecasting accuracy. Spontaneous accounts are directly related to sales, making them essential for accurate financial forecasting. Predicting changes in these accounts based on forecasted sales helps create a more comprehensive and reliable financial outlook. Resource planning. Resource planning. Understanding how spontaneous accounts change with sales allows companies to plan their resources accordingly. For example, if sales are expected to increase, a company can plan for higher inventory levels, additional staffing, or extended credit terms for customers. Working capital management. Spontaneous accounts like accounts receivables, accounts payables, and inventory significantly impact a company's working capital. Proper management of these accounts ensures that the company maintains adequate liquidity to support its operations. Profitability analysis. Monitoring the relationship between sales and spontaneous accounts helps in analyzing the profitability of different products, services, or business segments. It allows companies to identify areas where they are most profitable and areas that may need improvement. Investor confidence. Investors and stakeholders often analyze spontaneous accounts to assess a company's operational efficiency and financial health. Stable and well-managed spontaneous accounts can enhance investor confidence and contribute to a positive company image. In summary, understanding spontaneous accounts and their relationship with sales is crucial for financial forecasting, resource planning, working capital management, and overall performance evaluation of a company. These accounts provide valuable insights into a company's financial health and play a significant role in strategic decision-making. Sustainable Growth Rate (SGR). Let's expand on the key notes about the Sustainable Growth Rate (SGR) and explain in simple terms why they are important. The Sustainable Growth Rate (SGR) is the maximum rate at which a company can grow without having to rely on additional debt or equity financing to support that growth. In other words, it represents the growth rate that a company can sustain using its existing resources and profitability without taking on more debt or issuing more shares of stock. Explanation in simple terms. Imagine you have a small business that is currently growing at a certain rate, let's say 10% per year. The sustainable growth rate is the maximum rate at which your business can grow while still managing to finance that growth using only its profits and existing resources. It means that your business doesn't need to borrow money from banks or ask for more investment from shareholders to fund its expansion. Importance of SGR. Financial stability. Understanding the sustainable growth rate is crucial for a company's financial stability. It helps a company avoid excessive reliance on external financing, which can lead to increased debt and interest payments or dilution of ownership through issuing more shares. Long-term viability. By identifying the maximum rate of growth that can be sustained internally, a company can plan for long-term viability. It helps set realistic growth targets that the company can achieve without putting itself at risk. Capital structure management. Maintaining a balanced capital structure mix of debt and equity is vital for financial health. Knowing the SGR allows a company to make informed decisions about how much debt or equity financing it can afford to take on without jeopardizing its stability. Investor confidence. Sustainable growth is an attractive quality for investors. If a company can demonstrate that it can grow steadily without needing constant injections of capital, it can instill confidence in shareholders and potential investors. Operational efficiency. Achieving a sustainable growth rate often requires efficient use of resources and maximizing profitability. Companies that can grow without increasing their expenses at the same rate can enhance their overall efficiency and profitability. Strategic planning. Knowing the SGR helps management in strategic planning. It enables them to set growth targets that are feasible and align with the company's capabilities and financial resources. Risk management. Excessive growth without proper financing can strain a company's resources and increase financial risk. Understanding the SGR helps mitigate the risk of overextending the company's operations. Summary. The sustainable growth rate is a critical metric that indicates the maximum rate at which a company can grow using its internal resources and profitability, without relying on additional external financing. It promotes financial stability, efficient resource utilization, and long-term viability, which are essential for sustainable success and investor confidence. By staying within its sustainable growth rate, a company can maintain a healthy financial position and support its expansion in a responsible and controlled manner. Using return on equity (ROE) for SGR calculation. Basic equation of net income / total equity. SGR equals net income / total equity. DuPont equation of ROE. SGR equals net income margin x asset turnover x leverage multiplier. Explanation in simple terms. Return on equity (ROE) is a financial ratio that measures how efficiently a company generates profits from the money invested by its shareholders' equity. It indicates the percentage return on each dollar of equity invested in the business. Basic equation. If we use the basic equation for ROE, it's like asking how much profit net income is the company generating for each dollar of shareholders' equity. It indicates the percentage return on each dollar of equity invested in the business. DuPont equation. The DuPont equation breaks down ROE into three components. Net income margin. This measures the company's ability to generate profit from its sales. A higher net income margin means the company is keeping more profit from each dollar of revenue. Asset turnover. This indicates how efficiently the company utilizes its assets to generate sales. Higher asset turnover means the company is generating more sales with fewer assets. Leverage multiplier. This represents the level of financial leverage or debt used by the company to finance its assets. A higher leverage multiplier means the company relies more on debt financing. By using the DuPont equation, we can analyze which of these components contribute the most to ROE. If a company can improve its net income margin, asset turnover, or leverage multiplier, it can potentially increase its ROE and thus its SGR. Importance of ROE and SGR. Sustainable growth planning. Calculating the SGR using ROE helps companies set realistic growth targets based on their profitability and equity structure. It guides them in planning for growth that can be sustained without needing excessive external financing. Performance evaluation. ROE is a crucial metric for evaluating a company's financial performance. A consistently high ROE suggests efficient use of equity capital and strong profitability. Strategic decision-making. The components of ROE in the DuPont equation provide insights into areas where a company can improve its financial performance. Companies can focus on enhancing profit margins, optimizing asset utilization, or managing their debt levels more effectively. Investor confidence. A high and consistent ROE, along with a reasonable SGR, can attract investors' confidence and demonstrate that the company is generating value for its shareholders. Risk management. Understanding the relationship between ROE and SGR helps in managing financial risk. Companies can avoid aggressive growth plans that might strain their financial position and lead to increased risk. Competitive analysis. Comparing a company's ROE and SGR with its competitors allows for benchmarking and understanding relative performance in the industry. In summary, using return on equity ROE to calculate the sustainable growth rate SGR provides valuable insights into a company's financial health, performance, and capacity for sustainable growth. It helps companies set growth targets, make informed strategic decisions, and attract investor confidence by demonstrating efficient use of capital and profitability. SGR formula and importance. Let's expand on the key notes about the sustainable growth rate SGR formula and explain in simple terms why they are important. SGR formula. SGR equals ROE x 1-bit explanation. In simple terms, the sustainable growth rate SGR formula combines two important financial ratios, return on equity ROE and the payout ratio B. To calculate the maximum growth rate a company can sustain using its own retained earnings without having to raise additional equity or debt financing. Return on equity ROE. Return on equity ROE is a financial ratio that measures how efficiently a company generates profits from the money invested by its shareholders' equity. It indicates the percentage return on each dollar of equity invested in the business. A higher ROE generally implies that the company is effectively utilizing its shareholders' investments to generate profit. Payout ratio B. The payout ratio is the proportion of net income that a company distributes to its shareholders in the form of dividends. It is calculated by dividing the total dividends paid by the net income. The payout ratio represents how much of the company's earnings are being given back to shareholders as dividends rather than being reinvested back into the business. SGR interpretation. The SGR formula tells us that the sustainable growth rate of a company depends on two factors. ROE. The higher the ROE, the more profit the company generates from its equity, allowing for higher sustainable growth. Payout ratio B. The higher the payout ratio, the more earnings are being distributed to shareholders, leaving less money to be reinvested in the business for growth. The SGR represents the growth rate that a company can achieve using its retained earnings profits, not paid out as dividends, to finance growth internally without resorting to external financing like issuing new shares or taking on more debt. Importance of the sustainable growth rate SGR. Financial planning. Calculating the SGR helps companies set growth targets based on their profitability and dividend policies. It guides them in planning for growth that can be sustained without diluting shareholders' ownership or increasing debt. Capital structure management. The SGR allows companies to balance their financial structure. By determining the optimal level of reinvestment versus dividend distribution, a company can maintain a healthy balance between internal financing and external financing. Investor perspective. Investors use the SGR to evaluate a company's growth potential and dividend policy. A sustainable and reasonable growth rate signals a stable and healthy business that can generate returns for investors over the long term. Importance of the sustainable growth rate SGR dividend policy. companies must strike a balance between reinvesting profits for growth and distributing dividends to shareholders. The SGR helps management make informed decisions about the appropriate level of dividend payments. Risk management. Understanding the relationship between ROE, payout ratio, and SGR helps in managing financial risk. Companies can avoid overly aggressive growth plans that might strain their financial position and reduce dividend stability. In summary, the Sustainable Growth Rate SGR formula is a valuable tool for companies and investors alike. It enables companies to plan for sustainable growth while considering their profitability and dividend policies. By understanding the SGR, companies can strike a balance between retaining earnings for growth and rewarding shareholders through dividends, which is essential for long-term success and investor confidence. Importance of the Sustainable Growth Rate SGR. In summary, the Sustainable Growth Rate SGR formula is a valuable tool for companies and investors alike. It enables companies to plan for sustainable growth while considering their profitability and dividend policies. By understanding the SGR, companies can strike a balance between retaining earnings for growth and rewarding shareholders through dividends, which is essential for long-term success and investor confidence. SGR formula. Let's rewrite the Sustainable Growth Rate SGR formula to make it more understandable and then expand on the key notes in simple terms to understand their importance. SGR equals net income slash sales x sales slash assets x assets slash equity x1. Dividends slash net income. Explanation in simple terms. The revised SGR formula breaks down the growth rate into 4 components, each representing a crucial aspect of a company's financial performance. Net income margin. This represents the percentage of profit a company makes for each dollar of sales revenue. A higher net income margin indicates that the company is efficiently managing its costs and generating more profit from its sales. Asset turnover. This ratio shows how efficiently a company uses its assets to generate sales revenue. A higher asset turnover means the company is effectively using its resources to generate more sales. Leverage multiplier. This component indicates the level of financial leverage or debt used by the company to finance its assets. A higher leverage multiplier means the company relies more on debt financing. Dividend retention rate. This component represents the portion of net income that the company retains for reinvestment in the business rather than distributing it to shareholders as recasting. It helps companies set growth targets and determine whether they have the capacity to finance that growth internally. Investor confidence. Investor confidence. A company with a reasonable and sustainable growth rate, supported by efficient resource utilization and prudent financial management, can instill confidence in investors. In summary, the revised SGR formula breaks down the growth rate into key components, providing a more detailed understanding of a company's financial performance and capacity for sustainable growth. Each component plays a critical role in evaluating the company's health, efficiency, and ability to reinvest in itself. By comprehending and optimizing these components, companies can enhance their growth potential and attract investor confidence. Calculation of SGR for NGS Corp. Calculate the Sustainable Growth Rate SGR for NGS Corp. using the provided information and then expand on the key notes in simple terms to understand their importance. Given information, net income equals $2.66 million, dividends equals $1.0 million, sales equals $66.0 million, total assets equals $165.9 million, total equity equals $95 million, SGR equals 266.66 x 66 165 9 x 165 9 95 x 1 to 1 slash 2.66. Calculation. Net income margin equals net income slash sales equals $2.66 million slash $66.0 million 0403. Asset turnover equals sales slash total assets equals $66.0 million slash $165.9 million 03977. Leverage multiplier equals total assets slash total equity equals $165.9 million slash $95 million on 7463. Dividend retention rate equals 1. Dividends slash net income equals $1.0 million slash $2.66 million 06241. SGR equals 0403x 03977x own 7463x 06241 0579 or 5.79% explanation in simple terms. The SGR formula breaks down the sustainable growth rate of a company into four components, each representing an important aspect of its financial performance. Net income margin. Net income margin. This ratio tells us how much profit the company makes for each dollar of sales. In this case, for every dollar of sales, NGS Corp makes approximately $0.403 of profit. Asset turnover. This ratio shows how efficiently the company uses its assets to generate sales revenue. NGS Corp generates about $0.03977 of sales for each dollar of assets it has. Leverage multiplier. The leverage multiplier indicates how much debt the company has compared to its equity. NGS Corp has approximately $1.07463 of assets for every dollar of equity. Dividend retention rate. This component shows how much of the company's net income is retained for reinvestment rather than paid out as dividends. NGS Corp retains about 62.41% of its net income for growth and reinvestment. Importance of SGR. Why it's important. Sustainable growth planning. The SGR helps companies set realistic growth targets based on their profitability, asset utilization, financial leverage, and dividend policies. It guides them in planning for growth that can be sustained without excessive reliance on external financing. Resource utilization. Understanding the asset turnover ratio is important for assessing how efficiently a company is using its assets to generate sales. Higher asset turnover indicates better resource utilization. Financial health. The leverage multiplier indicates the level of financial leverage and helps assess a company's financial health. Too much debt can increase financing risk, while a healthy balance between debt and equity is essential for long-term stability. Dividend policy. The dividend retention rate reflects the company's approach to dividends. A higher retention rate means the company is reinvesting more in itself for growth and expansion. Investor confidence. A company with a reasonable and sustainable growth rate, supported by efficient resource utilization and prudent financial management, can attract investor confidence and potential investment. Strategic decision-making. The SGR components provide insights into areas where a company can improve its financial performance. For example, focusing on increasing net income margin or asset turnover can contribute to higher sustainable growth. Summary. In summary, the Sustainable Growth Rate SGR is a valuable metric that helps companies and investors assess a company's financial performance, growth potential, and dividend policy. By understanding and optimizing the components of the SGR formula, companies can plan for sustainable growth and enhance their overall financial health and attractiveness to investors. Strategies to reduce discretionary financing needed DFN. Let's expand on the keynotes about strategies to reduce discretionary financing needed DFN and explain in simple terms why they are important. Discretionary financing needed DFN. DFN is the amount of external financing a company needs to support its projected growth rate. It represents the additional funds the company must acquire through debt or equity financing to support its expansion beyond what can be generated from internal sources like retained earnings. Strategies to reduce DFN. Reduce sales growth. By increasing prices, a company can achieve two benefits: increased net income margin. Higher prices lead to higher profit margins, as the company is making more profit on each sale. Decreased need for assets and lower DFN. With higher prices, the company might experience reduced demand for its products, resulting in lower sales growth. Lower sales growth means less need for additional assets to meet higher demand, resulting in a reduced DFN. Obvious negative. The obvious negative to increasing prices is that it may lead to a decrease in customer demand. Customers may be unwilling or unable to pay higher prices, which could lead to a loss of market share or reduced sales. Review capacity constraints. Review capacity constraints. Instead of immediately buying new fixed assets to increase capacity, a company should assess whether there are alternative ways to increase production without significant capital investment. This could include optimizing existing assets, improving production processes, or outsourcing certain operations. Importance. Reviewing capacity constraints helps the company avoid unnecessary capital expenditures and ensures efficient use of existing resources. It can also reduce the need for external financing to fund new asset purchases. Lower dividend payout. Lower dividend payout. If the company retains more of its net income and pays out lower dividends to shareholders, it will have more cash available for reinvestment in the business. This increased retained earnings can be used to purchase new assets without relying on external financing. Importance: lowering dividend payouts allows the company to build up internal funds for growth and expansion. It provides a stable source of funding for capital projects and reduces reliance on external sources of financing. Increased net income margin. Increased net income margin. By focusing on improving operational efficiency, cost management, and pricing strategies, the company can increase its net income margin. A higher net income margin means the company is generating more profit for each dollar of sales. Importance: increasing net income margin directly impacts the company's ability to generate internal funds for growth. Higher profitability provides more cash that can be reinvested in the business and reduces the need for external financing. Sustainable growth. Managing DFN allows the company to achieve sustainable growth without overburdening its balance sheet with excessive debt or diluting shareholders' ownership through equity issuance. Investor confidence. Investors value companies that can finance their growth internally without constantly requiring additional external financing. It indicates strong financial management and efficiency. Importance of strategies to reduce DFN. Why these strategies are important. Financial stability. By implementing these strategies, the company can reduce its reliance on external financing, which enhances its financial stability and reduces financial risk. Flexibility. A company with lower DFN has more flexibility in making strategic decisions and capital investments, allowing it to seize growth opportunities as they arise. Cost effectiveness. Cost effectiveness. By optimizing existing resources and focusing on efficiency, the company can minimize unnecessary expenses and make the best use of its capital. In summary, the strategies to reduce DFN are essential for maintaining financial health, promoting sustainable growth, and ensuring efficient use of resources. These strategies allow the company to strike a balance between internal financing and external financing, enabling it to grow while remaining financially stable and attractive to investors. Forecasting in simple terms, making educated guesses about future events based on different types of data and methods. Helps in predicting financial outcomes and making informed decisions. Types of data in forecasting. Forecasting is basically making educated guesses about future events based on different types of data and methods. There are a few types of data we use in forecasting. Time series data. This is data collected over time at regular intervals, like daily stock market closing values. It helps us find trends and make predictions based on them. Cross-sectional data. This is data collected from many subjects at the same time, like measuring the height and weight of a group of people to figure out obesity rates. It gives us a snapshot of a population at a certain point in time. Longitudinal data. This is data collected from the same subjects over a long time, like tracking a group of people's health for many years. It helps us see changes and trends in these subjects over time. We also use judgmental methods in forecasting, which involves using intuition, opinions, and estimates to make predictions. For example, experts can use their knowledge to predict future technology trends. Now, in fields like finance and accounting, forecasting is used to estimate future financial outcomes for a company. It's like a financial fortune-telling. For example, economists can use past sales data and current market trends to guess a company's future revenue. One of the hardest parts of financial forecasting is predicting a company's future sales. Predicting future costs is a bit easier since we can use past accounting data and it's often related to sales. Importance of forecasting. A financial forecast is not the same as a financial plan or budget. It's more like a prediction of what might happen rather than a plan of what should happen. People outside a company can also use financial forecasts to guess how successful the company will be in the coming year. That's the gist of it. Forecasting is all about predicting the future based on the past and present, using different types of data and methods. Forecasting is like trying to predict the future. It's when we make statements about things that haven't happened yet. We use different methods and data to make educated guesses about what might happen in the future. For example, we might try to predict how much money a company will make next year or how many people will buy a certain product. Time series data in simple terms. Time series data in simple terms. Time series data is like a sequence of measurements taken at different times. We measure something repeatedly, like every day or every year, and then look for patterns or trends in the data. For example, we might track the stock market's daily closing value over time or the amount of water flowing in a river each year. Cross-sectional data in simple terms. Cross-sectional data is like taking a snapshot of a group of things at the same time. We collect information about many subjects at one specific point in time without worrying about how they change over time. An example is randomly surveying people to find out how many of them are considered obese at that particular moment. Longitudinal data in simple terms. Longitudinal data. Longitudinal data is like following the same group of things over a really long time. We observe the same subjects repeatedly over many years, even decades. It helps us see how things change over time and understand trends that happen over the long run. For example, we might study the same group of people over their entire lives to see how their behavior or health changes as they grow older. Mental model for forecasting. It helps us anticipate and plan for the future, even though we can't be 100% sure of the outcomes. Think of forecasting as looking into a crystal ball to see what might happen tomorrow, next week, or next year. Importance of forecasting. Importance of forecasting. Forecasting is important because it helps us plan for the future. Whether it's for a company, a government, or even predicting weather conditions, forecasting helps us make decisions and be prepared for what might happen. It's like looking into a crystal ball to see what's coming, even though we can't be 100% sure. By using different methods and data, we try our best to make accurate predictions and avoid surprises. Forecasting in simple terms. Forecasting in simple terms. Forecasting is like trying to predict the future. It's making educated guesses about things that haven't happened yet. We use different methods and data to estimate what might happen in the future, like how much money a company will make or how many people will buy a product. Mental model. Think of forecasting as looking into a crystal ball to see what might happen tomorrow, next week, or next year. Time series, cross-sectional, and longitudinal data in simple terms. Time series data. It's like tracking something over time and seeing patterns, like measuring stock prices each day or the annual flow of a river. Cross-sectional data. It's like taking a snapshot of many things at the same time, without worrying about changes over time. For example, measuring obesity levels in a group of people at one specific moment. Longitudinal data. It's like following the same group of things for a long time, observing how they change over decades. Think of studying people's behavior or health throughout their entire lives. Mental model. Imagine time series as a movie showing changes over time, cross-sectional as a photo of a group at one moment, and longitudinal as a documentary tracking individuals over a lifetime. Example exercise. Question. What type of data is it when we observe and measure the annual income of different families living in a city at the same point in time? Answer. Cross-sectional data. It's like taking a snapshot of different families' income at one specific time. Advantages and disadvantages of forecasting and importance to know. Advantages and disadvantages of forecasting and importance to know. Advantages. Helps plan for the future and make informed decisions. Assists in financial analysis and investment decisions. Allows companies to set growth targets and allocate resources effectively. Helps predict market trends and customer behavior. Disadvantages of forecasting. Forecasts may not always be accurate as the future is uncertain. It relies on historical data, which might not always reflect future changes. External factors like unexpected events or economic conditions can disrupt forecasts. Importance of forecasting. Forecasting is vital for businesses to make wise financial decisions and be prepared for the future. It helps analysts and investors estimate a company's potential success. Understanding different data types, time series, cross-sectional, longitudinal helps in choosing appropriate methods for analysis. Forecasting aids in managing risks and identifying growth opportunities. Mental model. Forecasting as a map. While it might not always be perfectly accurate due to changing roads and detours, forecasting provides guidance and direction. Think of forecasting as a map for businesses to navigate the future. Having a map is better than driving blindly into the unknown. Summary. In summary, forecasting is like making educated guesses about the future. We use different types of data and methods to estimate what might happen. Time series tracks changes over time. Cross-sectional is like a snapshot of a group at one moment, and longitudinal follows the same group over a long time. Forecasting is important for businesses and investors to plan and make decisions wisely, even though it may not always be 100% accurate due to the uncertainties of the future. 12 key points to understand the topic of forecasting. Forecasting definition. Forecasting is like predicting the future. It's about making statements about events that haven't happened yet. Types of data used for forecasting. Types of data used. There are three main types of data used for forecasting. Time series, it's like tracking data over time, like measuring stock prices daily. Cross-sectional, it's like taking a snapshot of many subjects at the same time without caring about changes over time. Longitudinal, it's like studying the same variables in a group repeatedly over many years. Judgmental methods in forecasting, this involves using our instincts, opinions, and best guesses to make forecasts, like taking expert opinions or conducting surveys. Key terms in forecasting. Remember important terms like probability sample, studying a subset with known likelihood, and non-probability sample subset without known likelihood. Forecasting in accounting. In finance and accounting, forecasting helps estimate a company's future financial outcomes based on historical data and market indicators. Financial forecast. It's an economist's best guess of a company's financial situation over a specific time, usually 1 year. Challenges in forecasting. Predicting revenue is one of the hardest parts of financial forecasting, and future costs can be estimated based on historical accounting data. Forecasting versus plans and budgets. A financial forecast doesn't have to be a planning document, and outsiders can use it to predict a company's success. Time series data. It's like a sequence of measurements taken at uniform time intervals, and it helps predict future values based on past data. Cross-sectional data. It's like observing and comparing many subjects at one point in time to understand differences among them. Longitudinal data. It's like studying the same group of subjects over a long time to track changes accurately. Importance of forecasting. Forecasting is crucial for making informed decisions, setting growth targets, and planning for the future. Mental model for forecasting. Think of forecasting as a crystal ball trying to predict future events using different data and methods. Imagine time series as a movie, cross-sectional as a photo, and longitudinal as a documentary. Judgmental methods are like taking expert advice to make educated guesses, and the key terms are like vocabulary you should remember to understand forecasting better. Example exercise. Question: what type of data is it when we track and measure the same group of people's weight and height every year for 10 years? Answer: longitudinal data. It's like observing the same group over a long period to understand how their weight and height change over time. Understanding forecasting. Understanding forecasting is essential in various fields, from finance to marketing, as it helps us plan and make better decisions for the future. Spontaneous assets. Spontaneous assets are items on a company's balance sheet that automatically grow as the business sells more products or services. They are things like accounts receivable, money owed to the company by customers, and inventory goods ready to be sold. Spontaneous assets are crucial for a company's day-to-day operations and are listed as current assets on the balance sheet. Fixed assets. On the other hand, fixed assets like buildings or equipment do not change with sales and are not considered spontaneous assets. The growth in spontaneous assets is significant for companies when they decide if they need to borrow money. If the company's incoming cash from sales is enough to cover its costs, it can avoid borrowing money, which lowers its financing expenses. Spontaneous liabilities. Just like spontaneous assets, there are also spontaneous liabilities. These are the company's obligations that increase with sales. An increase in cost of goods sold (COGS) is tied to an increase in spontaneous liabilities. Working capital, which is the difference between current assets and liabilities, is essential for a company to fund its daily operations. If current assets like cash, accounts receivable, and inventory are not enough to cover current liabilities, the company may face financial difficulties in meeting its spontaneous liabilities. In summary, spontaneous assets are essential for a company's day-to-day business, and they grow as the company sells more. If the company manages its spontaneous assets well, it can better handle its liabilities and keep its operations running smoothly. For example, when a company receives orders for products, it manufactures more goods inventory to sell, and as it makes sales, it receives accounts receivable and cash deposits. These are considered spontaneous assets that naturally grow as the business expands. In summary, spontaneous assets are essential for a company's day-to-day business, and they grow as the company sells more. If the company manages its spontaneous assets well, it can better handle its liabilities and keep its operations running smoothly. Understanding spontaneous assets is crucial for businesses to plan for growth and make informed financial decisions. By knowing how these assets change with sales, companies can manage their resources effectively and ensure smooth operations without running into financial difficulties. Spontaneous assets are like the automatic helpers a company gets when it sells more stuff. When a company sells products or services, some things naturally grow along with it, like money owed by customers' accounts receivable and goods to be sold inventory. These automatic helpers are essential for the company's everyday operations and are shown on the balance sheet. However, things like buildings or equipment, which don't change with sales, are not part of spontaneous assets. Mental model/analogy. Imagine a company as a garden that sells flowers. When the company sells more flowers, its garden automatically grows some extra flowers and keeps them ready to sell inventory. Customers who buy flowers promise to pay later, so the company keeps track of the money they owe accounts receivable. These automatic helpers grow along with the company's sales. Example exercise. Question. If a company sells 100 widgets in a month and each widget costs $10, how much will be the accounts receivable if customers are allowed to pay later? Answer. The accounts receivable will be $1,000 100 widgets x $10 each. Advantages and disadvantages. Advantages. Spontaneous assets are like natural support for a company's growth. As sales increase, these assets grow automatically, helping the company handle more business without extra effort. This makes it easier for the company to manage its daily operations. Disadvantages. While spontaneous assets are helpful, they also come with responsibilities. For example, if the company doesn't keep a good balance between its current assets and liabilities, it may struggle to meet its obligations and face financial challenges. Importance of knowing spontaneous assets. Understanding spontaneous assets is crucial for businesses to plan for growth and make informed financial decisions. By knowing how these assets change with sales, companies can manage their resources effectively and ensure smooth operations without running into financial difficulties. Spontaneous assets are those accumulated as a result of the company's day-to-day business operations. An increase in spontaneous assets is normally tied to a decrease in a company's cost of goods sold or an increase in revenues. Spontaneous assets often include accounts receivables, inventories, and working capital. Spontaneous assets. What are spontaneous assets? Spontaneous assets, or stuff a company gets as it sells more, helps the company to decide if it needs to borrow money. If the money coming in is enough to pay for the running costs, it's cheaper for the company because they don't need to borrow money. Just like spontaneous assets, spontaneous liabilities, or the money a company owes, also changes with the amount of sales. These are the expenses a company naturally gets when it does its usual business. More sales usually mean more expenses, like the cost to make the products or services they sell. Working capital, which is the money and assets a company has to run its business, is really important. If a company doesn't have enough cash or money it's waiting to get or stuff it's going to sell compared to the money it owes, it may find it hard to pay its expenses. Why spontaneous assets are important. How much spontaneous assets a company expects to get or lose is really important. This helps the company to manage its spontaneous liabilities or the money it owes, which is normally listed in the current liabilities section of its financial report. Current liabilities are the money a company needs to pay soon, like money owed to suppliers or for services. Working capital, which is what a business has left after subtracting the money it owes soon from the money and stuff it has, is really important to keep the business running. If the business doesn't have enough cash, money it's waiting to get, or items it plans to sell to cover its debts, it could find itself in a tough money situation. For instance, let's say your business makes widgets. When you get more orders, you make more widgets to sell. Selling these widgets leads to customers owing you money accounts receivable and money in your bank cash assets. These are examples of spontaneous assets because they grow as your business does its regular activities. What are spontaneous assets? Spontaneous assets are things a company automatically gets when it sells more products or services. Types of spontaneous assets. Common spontaneous assets include money owed by customers' accounts receivable and goods ready to be sold inventory. Not all assets are spontaneous. Spontaneous assets are connected to sales, but fixed things like buildings or equipment aren't part of them. How they grow. As a company sells more, spontaneous assets naturally increase, helping with everyday business. Cost of goods sold, COGS, and revenues. When spontaneous assets grow, it's often because the cost of making goods decreases or sales increase. What are spontaneous assets? Working capital matters. Working capital is the difference between current assets like cash and inventory and current liabilities, debts due soon. It's vital for a company's operations. Evaluating borrowing needs. Companies look at projected spontaneous asset growth to see if they need to borrow money to cover costs. Spontaneous liabilities. Just like spontaneous assets, some liabilities also change with sales. These are called spontaneous liabilities. Importance of balance sheet. Spontaneous assets and liabilities are both important for companies to manage as they are recorded on the balance sheet. Financial challenges. If a company's current assets don't consistently exceed its current liabilities, it may face financial difficulties. Short-term obligations. Current liabilities include things like money owed to vendors or service providers that need to be paid soon. Example of spontaneous assets. Covering spontaneous liabilities with short-term assets. Example of spontaneous assets. If a company sells more widgets, it will naturally have more widgets to sell. Inventory and money owed by customers. Accounts receivable. Impact on companies' financial health. Understanding spontaneous assets helps businesses plan for growth, manage their finances, and ensure they can meet their obligations without facing financial troubles. Spontaneous liabilities are like bills that a company automatically accumulates while doing its regular business. These liabilities increase when the company sells more products or provides more services, leading to higher costs. The key spontaneous liabilities usually include things like accounts payable. These are short-term debts the company owes to its suppliers or creditors for things like raw materials. The company gets some time to pay these bills, like 30, 60, or 90 days in the future. Wages payable. When there's more work to do because of increased sales, the company may have to pay workers more, like for overtime or extra shifts. Taxes payable. If the company makes more profit from higher sales, it may owe more taxes to the government. These liabilities are called spontaneous because they come up automatically due to changes in sales. They are not directly controlled by the company itself, but depend on how much the company sells. For example, let's take Tesla as an example. When Tesla's car sales went up by 64% in 2019 compared to the previous year, its revenue money earned from selling cars increased by a lot. But the cost of making those cars, like buying materials and paying workers, increased even more by 68%. And this increase in costs is a spontaneous liability because it's directly linked to the increase in car sales. 12 key points of spontaneous assets. What are spontaneous assets? Spontaneous assets are things a company automatically gets when it sells more products or services. Spontaneous assets are those accumulated as a result of the company's day-to-day business operations. An increase in spontaneous assets is normally tied to a decrease in a company's cost of goods sold or an increase in revenues. Spontaneous assets often include accounts receivables, inventories, and working capital. Types of spontaneous assets. Spontaneous assets typically refer to those assets which are generated automatically from the day-to-day operations of the business. They are tied to the level of a company's operations. As sales increase, these assets usually increase, and as sales decrease, these assets typically decrease as well. Here are the two main types of spontaneous assets. Accounts receivable. These are the amounts owed to a business by its customers for goods or services delivered or used on credit, but not yet paid for by clients. As sales increase, accounts receivable can increase correspondingly because customers may purchase more goods or services on credit. Inventory. This represents the raw materials, work in process goods, and completely finished goods that are considered to be the portion of a business's assets that are ready or will be ready for sale. Inventory is categorized as a current asset on a company's balance sheet, and it serves as a buffer between manufacturing and order fulfillment. When an inventory item is sold, its carrying cost transfers to the cost of goods sold (COGS) category on the income statement. Not all assets are spontaneous. There are many types of assets that do not directly correlate with the level of a company's operations. These are considered non-spontaneous assets, and they include cash and cash equivalents. These are the most liquid assets and can include treasury bills and short-term certificates of deposit, as well as hard currency. Fixed assets. These are long-term tangible pieces of property or equipment that a firm owns and uses in its operations to generate income. Fixed assets are not consumed or sold during the normal course of business. They include items like buildings, machinery, and land. Long-term investments. These can be bonds, shares, or real estate properties that a company plans to hold for more than a year. Intangible assets. These are non-physical assets that have a monetary value since they represent potential revenue. Intangible assets can include patents, copyrights, franchises, goodwill, trademarks, and trade names. These non-spontaneous assets are critical to a company's long-term success and can provide a competitive advantage for the firm, but they do not fluctuate directly with changes in sales or revenue. Spontaneous assets grow. Spontaneous assets, such as accounts receivable and inventory, are directly linked to a company's business operations. Let's simplify this with an example. Imagine you own a company that makes shoes. If the cost of making shoes decreases, maybe you found a supplier who sells materials at a lower price, or you improved your manufacturing process to make it more efficient. As a result, you can produce more shoes for the same amount of money. This means your inventory, a spontaneous asset, increases because you now have more shoes in stock. If your sales increase, more customers are buying your shoes, maybe because you launched a successful marketing campaign. When you sell shoes on credit, meaning your customers promise to pay you later, these sales increase your accounts receivable, another spontaneous asset. This is the money your customers owe you for the shoes they bought. In both cases, your spontaneous assets grow. Either you have more shoes in your inventory, or your customers owe you more money, and both can be good for your business. Because more inventory means you're ready to meet customer demand, and higher accounts receivable means more cash coming in when customers pay their bills. Evaluating borrowing needs. In a business scenario, a company might predict that its operations are going to grow, maybe because they're launching a new product or expanding into a new market. This growth could lead to an increase in spontaneous assets, like inventory, more products to sell, and accounts receivable, more customers buying on credit. If the company doesn't have enough money on hand to cover the costs associated with this growth, like manufacturing costs, employee salaries, or marketing expenses, it may need to borrow money, perhaps in the form of a business loan or line of credit. By predicting their spontaneous asset growth, the company can plan ahead and ensure they have the financial resources they need to support their growth. Spontaneous liabilities. Imagine you're organizing a big event, a music concert. You hire a sound system, lighting, and a stage setup from a supplier, and they give you a month to pay them back. This debt you owe them is like a spontaneous liability. Why is it spontaneous? Because it directly relates to your event. The more grand your event, the more sales or revenue you make, the more elaborate sound system, lighting, and stage setup you may need. As the size of your event grows, so does the money you owe to your supplier. If you have a smaller event, you'll owe less. This liability changes with the size of your event. Similarly, in a business context, spontaneous liabilities are debts that grow with the business. For instance, as a business sells more, it may need to buy more raw materials or inventory from its suppliers. If the suppliers allow the business to pay them later, the money owed accounts payable would be considered a spontaneous liability. As the business activity sales increases, so do the spontaneous liabilities accounts payable, and vice versa. Importance of balance sheet. Think of a company like a giant seesaw with spontaneous assets on one side and spontaneous liabilities on the other. The balance sheet is like the fulcrum or the center point that keeps the seesaw balanced. On one side, you have spontaneous assets like inventory and accounts receivable. This is stuff the company has or is owed, like products ready to be sold or money customers owe the company. On the other side, you have spontaneous liabilities like accounts payable and accrued expenses. This is money the company owes to others, like bills to suppliers or salaries to employees, and the goal for a company is to keep the seesaw balanced. If a company has a lot of assets but also a lot of liabilities, it needs to make sure it can pay off those liabilities using its assets. If it can't, the seesaw tips and the company could find itself in financial trouble. In other words, managing spontaneous assets and liabilities involves keeping an eye on what the company owns and owes. It helps the company maintain a healthy financial balance and ensures it can continue to operate and grow. This balance between assets and liabilities, and how well the company manages them, is reflected on the balance sheet. Long-term obligations, long-term liabilities, also known as long-term debts or non-current liabilities, are the big bills a company doesn't have to pay for more than a year. These are listed separately on the balance sheet, a company's financial scorecard, to give a clear view of the company's immediate and future financial responsibilities. Here's a quick rundown. Long-term liabilities are debts due in over a year. These are listed separately on the balance sheet. While short-term liabilities are paid with cash on hand, long-term liabilities can be paid off with money made from regular business and other future activities. Long-term liabilities include things like big loans, future tax payments, and money for pensions. They're not due within the next year or even longer, depending on the company's operating cycle, the time it takes to sell its products and get paid. Sometimes, companies can move debts from the due soon list to the due later list if they are in the process of refinancing or if they have set aside a long-term investment to pay the debt, as long as there's enough money to cover it. Examples of long-term liabilities include the majority of bond debt, lease payments due after a year, future tax payments, and loans for big purchases like property or equipment. Long-term liabilities are important for analyzing a company's financial health. They help show if the company can cover its immediate debt with cash on hand, and if its long-term debt can be covered by regular business income, future investments, or new loans. Companies often compare their debts to their assets or to their equity, the value of the company after all debts are paid, to understand their financial leverage. How much of the company is owned versus owed. In a nutshell, long-term liabilities are the big bills due in the future. They contrast with short-term liabilities which are due within the year. By understanding both, a company can better plan its finances, make more informed decisions, and ensure it stays afloat in both the short and long term. Short-term obligations. Short-term obligations, also known as current liabilities, are like immediate tasks or bills a company needs to pay off soon. Here are some examples. Money owed to vendors. Let's say a bakery buys flour from a supplier and has 30 days to pay. This money they owe to the flour supplier is a current liability. Service providers. Imagine a clothing store that hires a company to clean their store every week. The money they owe to the cleaning company is another example of a current liability. So, current liabilities are kind of like the chores a company needs to do. They're the bills it needs to pay or the debts it needs to settle shortly, often within a year. Just like how you can't ignore your chores at home, a company can't ignore its current liabilities. They have to make sure they have enough money to cover these costs so they can continue operating smoothly. Key spontaneous liabilities. There are certain debts or liabilities that a company might have which can grow when the company is doing more business or making more sales. These are known as spontaneous liabilities. Here are some main ones. Accounts payable. This is the money a company owes to its suppliers. For example, if a toy store orders more toys to sell during the holiday season, they'll owe more money to their toy suppliers. Wages payable. This is the money a company owes to its employees. For instance, if a restaurant is really busy, it might need to have more staff working, which means it will owe more in wages. Taxes payable. This is the tax a company needs to pay based on its income. If a company sells a lot of products or services, its income will be higher and it will owe more in taxes. So when a company's sales go up, these spontaneous liabilities, accounts payable, wages payable, and taxes payable, can also go up. It's important for a company to keep track of these so they don't spend more money than they are bringing in from their sales. Managing spontaneous liabilities. Why are spontaneous liabilities important? Well, companies need to manage their finances properly to make sure they can handle these spontaneous bills. They need to have enough short-term assets like cash and money owed by customers' accounts receivables to cover these liabilities. If they can't cover these bills comfortably, it can lead to financial problems for the company. Importance for investors. Investors need to watch how much money a company spends to make sales. Even if a company sells more, if it spends too much money to do so, it could hurt its financial well-being. Summary. So, in a nutshell, spontaneous liabilities are like automatic bills that increase when a company sells more, and it's crucial for companies and investors to keep track of them to stay financially healthy.